episode of Capital Clarity. It is 10:20 a.m. on June 3rd, 2026. Hi, Rick.
Hi, Keith. Life's good, huh? I was at the
Yeah,
gym this morning thinking about how good life is.
weather's beautiful. It's summertime. Well, still technically spring, I guess, but almost
It's
summertime.
summer. It's
It's
summer.
summer.
Yeah,
Yeah,
I was
yeah.
I was sitting there today doing almost gratitude, you know, recitals in my head as I'm working out. I mean, my family's happy, healthy, together. Summer's here, like you said, the weather. Our business keeps growing. We've been lucky to have a lot of clients introduce us to the people they care about. That's really fun.
The
Our
Eagles
clients are
traded
making
AJ
money.
Brown.
What's that?
The Eagles traded AJ
The
Brown. He's
Eagles traded
finally
AJ
gone.
Brown. Yeah, that saga's over. We'll see how that pans out this season. Our clients are making money. I mean, you got to say that. It's fun to see them do well and succeed, and that's always happy.
Yeah.
I was down the shore last weekend. I'm going down this weekend. I think you might be too, right?
I'm going down this weekend. I was at Busch Gardens last weekend in
Oh,
Virginia,
yeah.
which was I've never been there before. It was a lot of fun. It's very crowded, but a lot of fun.
Yeah, I haven't been there in like 40 years, literally, so I have no perspective on what that place is like now.
I don't find myself at amusement parks very often in
Okay.
recent years, but when I get burnt out on them easily. It's I enjoy myself for the first maybe 2 hours, and then after that, it's grab a beer, some lunch, and then I'm probably good to go.
Yeah. No, I get it. Well, especially it depends how crowded they are.
That's the
Busch
thing, it's the
Gardens is
crowds.
really
Yeah.
Busch Gardens is fun. I mean, I haven't been there, but
Oh
people
yeah.
always rave about it. But yeah, it always depends on the crowds, you know.
Yeah.
And then we're going to Denver, Colorado this summer. That'll be
That'll be
fun.
fun.
And we're going
That'll
to
be fun.
Asheville, North Carolina as well. It's going to be
That will
great. Great
be a
summer.
lot of fun.
Great
Yeah.
summer teed up, and it feels good to be here. So good.
Life
All
is
right.
good.
You kicking
I'll
us off?
I'll kick us off today if that's okay.
Go.
I found some interesting inflation stats recently. I know, not the most interesting thing in the world, but I feel like it's a topic right now. Look at ground beef. I never noticed this. From the Bureau of Labor Statistics, up 78% since 2020. Um, I guess it's one of those things. Grocery items, I feel like for a lot of people are one of those things that you notice the general prices of going to the grocery store going up, but actual items like eggs, ground beef, milk, you don't really look at specifically in a vacuum. But when you do, it's also because on a relative basis, up 78% since 2020. It went from $4, a pound to $7 a pound. That's it's I
People.
guess under $4 to just under $7. But it's one of those things where you're like, oh, it's up $3, but that's a lot on
That's a
a
lot. People feel
on a
that.
percentage basis. Yeah,
Well, it's
yeah,
like gas prices. So if you put the, not that you have it, the chart of the price of eggs, that's down significantly. People notice that. But, uh, you know, I have a newer friend who owns a farm in near Percy, and was telling me specifically, and I've heard this from a few other people, that the bottleneck in the price of beef, and this is ground beef, but it doesn't matter if it's steaks or whatever it is literally the slaughterhouses. I know it's kind of dark, but they just can't process the they can't process the meat. It's sort of like refineries with oil. There are so few refineries, and if one goes offline, it really can spike, gasoline prices, which are a refined product from crude oil, of course. And so it's like the bottleneck is not that we don't have enough of it, it's that it can't be processed into the thing we want, you know?
interesting.
Yeah.
Well,
That's a
one
scary
more.
chart though if you're a carnivore.
It is, as I find myself to be. Um, One more thing on inflation. Um, this was an interesting chart from Charlie Bolello. I feel like since 2020, it's been just this never-ending battle against inflation to get it at or below 2%, that we get close to, but never actually succeed at. Um, I feel like this is just going to continue for the next few years. It's same old song and dance, old news. But if for those of you listening, it says as in 62 consecutive months, with U.S. inflation above the Fed's 2% target, CPI has now averaged over 4% per year since the start of 2020. The Fed has lost all credibility when it comes to fighting inflation. I tend to agree.
Yeah, I mean, when the Fed set that, listen, they're human, and they set this. Our targeted inflation rate is 2% or less. I remember being like 2%. I mean, that'd be great, and you
No, it is
know,
a long shot, but still,
I mean, in
it's
mid
been
twos,
six
more
years.
real. Yeah, no, they've definitely missed it. Uh, it's tough. I mean, I wonder if in 5 years, 10 years, we look back at this and say, "Wow, artificial intelligence created so much efficiency that look how low inflation is." Something. The Fed can only control so much. They do have, they can put their hand on the scale with fiscal and monetary policy. Like they could raise interest rates, and that would slow the economy and crimp inflation and bring it down. Most likely, that's usually what works. But I wonder if market forces might do it as well. I wonder if they're kind of holding their breath for that to happen, possibly.
Yeah, yeah.
Could be.
It's interesting to see this in a chart because every year you hear about it's going to get to 2% or below this year, and nope.
Yeah. Yeah. Hey, this is why in financial plans for clients we build higher than historical inflation assumptions just to protect them from this scenario. You know,
Yeah,
really, really important. Uh, all right, check this out. You were a college athlete playing football. Pretty
I
cool. Well,
was.
this is about the pros. So this is
I
an
had
image.
this same one.
Do you have this? This is pretty good.
Yeah.
Visual, I think it's Visual Capitalist. And I don't have the whole image. There are more sports below. But anyway, it's just basically saying, your odds of reaching the elite level. Basically, how hard is it to go pro in different sports? And tennis, the most difficult. It's a 1 in 2 million shot that you'll end up going pro if you're a tennis player. Golf, 1 in 1 million. MMA, 1 in 500,000. So mixed martial arts. Football and soccer are about 1 in around 400,000, which is I remember being a high school football player thinking, hey, I wonder if some. Well, actually, I wasn't thinking that. I was too small, but you're a little kid, you might dream of it, right? Baseball probably when you're a little kid. Basketball, it's 1 in 140,000, which is surprising to me considering how few players are on a basketball team, professional basketball team, and how many people do play basketball. Ice hockey, 1 in 100,000. I think that's more of a symptom of a lot less people play ice hockey when they're younger or not pro versus the other sports. But pretty wild, huh?
Yeah. What I love about when I looked at this chart or graphic, I guess, what I loved about this was how they define what the elite level is. That column, what made it means. Reaching the PGA Tour with golf, playing in a top five European league for soccer, making an NBA roster for basketball, making the NHL for hockey. Um, I think there's a few barrier to entries with these, top eight here. One, it's just how many people are on a roster versus how many people in the world do it. Tennis,
Right,
you're not playing with 50 other people on a team in tennis. It's kind of
right.
just you. And let's face it, it's a world sport. It's not like American football where very few countries participate. Um, and then also probably a money barrier. I mean, look at Formula One, ice hockey, and I'd say golf. Those three, and probably tennis. Those four sports. It's expensive as a kid to start doing those sports. You're not
Yeah.
just gonna pick up a race car and start, get in a race car and start racing F1 or hockey pads and sticks and
Well,
playing is
and
expensive and golf's very expensive.
yeah, yeah, and
And
ice
then
hockey's one where you need parents that are really dedicated as good parents when you're very young, because usually you're getting ice time at 10 o'clock at night when you're a peewee. You're not getting the
yeah.
prime ice time. Your
And then
parents
I'd
have to be
say
able to do that and willing to do it.
exactly, exactly. And then I'd say another factor in this is probably uh, brutality, toughness. I'm not saying it's only these three, but just singling out three: MMA, ice hockey, and F1. I mean, some brutal injuries and nasty, violent injuries in those
Yeah,
sports. You got to be willing to, put your body on the line a little for those sports,
yeah.
and I think
Start
that's a
to
big
weed
barrier
people
to
out who
entry.
go, I'm not doing that. You know?
Especially MMA.
Yeah,
The odds. I'd love to see like the odds of you making money in that versus having a severe
yeah,
permanent injury. It's just yeah.
yeah, yeah. Amazing. All right, cool. What
No,
do you
that
got?
was really cool. Yeah. Um. All right. I have an interesting chart here. Not one I usually show. From Kevin Gordon. U.S. household ownership of corporate stocks and mutual funds now totals $58 trillion, dollars, which far exceeds real estate assets totaling $48 trillion. dollars. I think this is an interesting chart because really, I mean, that's happened, it looks like on this chart since 1989, once before around 2020. But really, for the vast part of American history, I mean, people have owned the typical American has owned more real estate assets than equity assets, and that tide seems to be shifting a little bit.
Yeah, that's interesting. If you hadn't shown me this and you asked me, the average person, do they have more money of their net worth in real estate or in basically stocks? I would have said, oh, it's real estate. It's always real estate. Makes me think like
This has to
what.
be also due to stocks going up so much. But
Well, the only thing is, real estate's up quite a bit, but stocks are up more. Yeah, you're right. That's probably part of it. What I think too is that we've had kind of a democratization of access to the stock market in the last, I don't know, 30 plus years, where now you can be a high school kid and set up a Robinhood account, and if you got some money, drop it in there and start buying stocks. A lot of times it doesn't work out real well, but you can do that. But people who do that, it starts their learning curve on investing in the stock market a lot earlier, and it breeds a younger, sooner arriving generation of stock investors. Whereas, you're not going to be in high school and go out and buy a rental property. So I wonder if that's part of it too. Just access is so
yeah,
much easier now. 40, 50 years ago, how would you couldn't do that. You couldn't
yeah.
even get close to doing that. So
And I get it. You can't live in a stock. You can't live in a mutual fund. So a lot of these, for a lot of history, it's been, well, people's primary residence is also, their investment asset.
yeah,
Um, but still, when you look at the returns. I mean, just even during this time frame, 1989 to 2025, when you look at the average annual returns of American residential real estate versus American equities have on an annual basis performed better. And even with that, real estate has far outpaced equities in household ownership. So
yeah,
it's
yeah,
amazing to see how real estate's dominated for so long.
yeah, yeah. All right. I don't want to spend a lot of time. Well, I don't know. You might have something on it, but on SpaceX, we've talked about it. We beat that to
No, I
death
got
over the
nothing on
last.
SpaceX today,
All right.
shockingly.
I'm not going to spend a lot of time on it, but just real quick, I found a great image that I want to share because it speaks to, be careful with IPOs. You got to know what you're getting into. So SpaceX is going to launch its IPO, I think, in the next few weeks. And basically, think of this: it's a $1.8 trillion company, but they're only selling in this IPO $75 billion worth of shares. So how could it be a $1.8 trillion company if they're only selling to the public for the IPO $75 billion worth of shares? Well, it's because a whole bunch of people with a lot more money got in over the last 5 or 10 years before the IPO, and that's the larger portion of the pie. Now they're going to launch the IPO, and I wonder if initially, at least, a bunch of people getting into the IPO are going to end up being the bag holders, where the long-time purchasers at much lower prices unload onto these unsuspecting
Mm,
buyers. So there's this. I got this great image from Keith Lerner at Truist,
great first
and
name.
Keith, yeah, Keith Lerner, of course, Keith. So
The
check this out.
few.
So this is an image showing returns for major IPOs that you're going to know if most, if not all, the names within a week of their launch, a month, 3 months, 6 months, and 12 months after their launch. So the stock gets IPO'd, there's an IPO price, then it starts trading in the market. Okay, what did the stock do once it started trading in the market? And it's kind of mixed when you go out any of those periods, a week, a month, 3 months, 6 months, 12 months. I mean, Facebook was down 17% in the first week, 18% in the first month, and so on and so forth. At the end of 12 months, Facebook was a year, it was down 31% from the IPO price. People who bought Facebook on the IPO went a year later went, oh man, I just lost almost a third of what I invested in that. Now, of course, it went on to greater things, and we all understand this. But you see kind of a recurring theme with so many of these big name stocks. I mean, Twitter was very similar. Alibaba, which is like the Amazon of China, had the same thing, similar thing. Lyft, the competitor to Uber. Uber had a very similar thing. You get some outside winners. Palantir was an outside winner. A year later, was up 153%. Coinbase. Anyway, you can see the list. But I think the column that's most interesting is the furthest right column that says
I was just looking at that. Yeah.
year one max drawdown. The median drawdown, meaning the max pain, if you bought any of these very big stocks at the IPO and held it for a year, the median loss you had to suffer through while waiting for it to do something was 54%. So you put 100 grand in to all these, spread out, let's say, across them all in the same day. Within the first year, at some point, you only had $46,000 worth of money. And you had to muscle through that to get to what were likely better times for most of them. So the initial IPO launch and the first year, this data, it's kind of what you and I know from experience, but this data is shocking when you go, wow, it's a rough ride being an IPO buyer, even of the biggies.
Look at Robinhood, down 90%. That's the year one max drawdown for Robinhood after the IPO. If you put $1 million in Robinhood when they IPO'd, you had to suffer a $900,000 downturn. In that portfolio.
I mean, it's like people who are getting shares right now being told that, okay, hey, you got shares in the IPO for SpaceX. It's almost like, hey, congrats on getting in early, but unfortunately, so did everyone who's going to sell you those shares. You're kind of the bag holder.
Let the corporate execs, cash out first, then buy SpaceX. I feel like part of it with SpaceX is also, this might sound, mean of me, but getting to tell your friends, I got in on the SpaceX IPO.
There's cachet.
It's really not that big of a deal, but it's like a status thing.
Yeah. Did you get some? I got some.
Yeah.
It's one of
you
those
didn't
things.
get any SpaceX IPO?
Yeah. To me, it feels less like early stage investing and more like late stage donating, to somebody else's cause, So anyway,
that's a great chart.
It's a little frightening, right?
That's a phenomenal. That might be the chart of the day right there. I'm going to stay on real estate. So talking about young Americans, meaning, and this chart from Visual Capitalist defines young Americans as under 35. This chart shows where they own homes. So homeowners under 35, which Visual Capitalist calls young Americans, where they own homes in the U.S., which states. The highest being Minnesota at 51%. Young adult homeownership in Minnesota is at 51%. Yeah, and young adult homeownership in Hawaii is at the lowest at 25%. That's one
every house is $1 billion.
That's one I could have guessed though, because that's tough for non-young Americans to own homes in Hawaii. So yeah, in Hawaii, more than 3 and 4 young adults are priced out in Hawaii. But that makes a lot of sense. New York's another one that makes sense. California, both at 28%. The rest of the states, it kind of seems to hover around 40%. So 40% of young adult homeownership in a lot of the other states. Pennsylvania at 44%. But I thought this was just an interesting.
It seems like
to see where young Americans are buying homes.
It seems like if you go Midwest or more South, generally, it's affordability. But Midwest
Maine,
or more
though.
South. Oh yeah, Maine 45%. Well, my youngest brother lives in Maine, and he talks about how affordable generally it is to live there. I mean, really inexpensive. So that makes sense. Yeah. That's pretty cool. That's a cool chart. Because young person homeownership is a major topic right now. People just feel boxed out of the ability to buy a home. And
West Virginia, 50%, just behind Minnesota.
Look at that.
It's funny because it's interesting because West Virginia is kind of sandwiched in between all these other states where it's tougher for young Americans to own homes, and then West Virginia, very affordable.
Yeah, that's pretty cool. So take a little shot at Michael Burry. Michael Burry was the
we're gonna get backlash if you take a shot at Michael Burry.
No, people won't care. The guy's brilliant. He made billions in the 2008 great financial crisis, And but I think my hunch is his fund, his private fund that he runs right now, must be doing well. But this is just an example of, sometimes these very smart fund managers that have private funds say one thing but are doing another. Not deliberately. It's just I don't know. It's always it seems like a mismatch. But I mean, he's constantly issuing negative warnings about the Nasdaq index, the Nasdaq Composite, and this is just an image showing, in 2018 he said it'll be ugly, and of course the Nasdaq was all the way down around 7,500, and then it climbed to 15,000 after he said that. And then it falls during the 2022 period, and at right about near the bottom at about 10, 11,000, he says it's going to be worse than 2008. And then right after that says sell, and it proceeds to go from 11,000 up to above 25,000. And just in the last month, he said it's going to be a car crash in the Nasdaq. Well, it's above 25,000. You started saying this when it was 7,500. So you got to watch when the gurus, and this guy deserves a ton of credit. He saw things in the great financial crisis nobody else saw, and had the guts to make money off of it. But just the gurus and talking heads on TV, it doesn't always work. It often doesn't work what they're saying on the TV or Twitter or wherever it is.
Yeah. I think it was one of our earlier episodes. I pulled up a chart of all the times since the great financial crisis he has incorrectly tried to predict just movements in the general stock market, whether it be the Nasdaq, the S&P, the Dow.
Yeah, it's
Yeah.
tough.
Yeah,
It's tough to do.
Yeah.
But
It's
because of his
it's
track record, people believe it and go, "Oh, well, he said this, and that guy has a track record."
and I don't blame people for believing it, because it wasn't impressive what he did during the great financial crisis. Not only predicting that, but also putting
Yeah,
his career and finances on the line, and
yeah.
completely cashing out. But um, Rick, I am worried about inflation. I think I'm going to buy a whole lot of gold. What are your thoughts on that?
Well, I
I'm gonna
know.
cash out of my stock portfolio, 100% stock portfolio, and move that money to gold because I'm worried about inflation. What are your thoughts?
So we we had some of the most rampant inflation during and just after the COVID era, when the government shot free money into the economy like T-shirts out of a hand cannon at a basketball game or a hockey game. And during that period of really rampant inflation, gold just laid there and did nothing. Now, in the few years after that, gold has done quite well, but it wasn't inflation related. I think gold's correlation to inflation is not there and hasn't been since the 70s. It's just, it's if it happens, it's coincidental. So I don't think that would be a reason to buy gold. Doesn't mean gold equals bad. That's not the real reason to do it. So what are you going to
Well,
tell me?
that is a great answer, because looking at from Y charts, the annualized total returns between US stocks and gold from 1975 to 2025, US stocks have had an annualized return of 12.5 and gold at 6.4. And inflation has been at 3.7. So just looking at this, I'd venture to say that'd be a terrible decision, and I should leave my money in US stocks, because when more money, aka inflation, gets pumped into the US economy, it's probably gonna flow to stocks eventually. And that
Yeah,
just is a better hedge against inflation just based on the data. So I get it. People think, oh, it's this shiny object that is ever existent and will protect me against inflation. It can, but not as much as other investment vehicles.
yeah, yeah. I mean, this chart shows you over the last 50 years, gold has outperformed inflation, but not
Barely.
nearly what stocks have done. Stocks have doubled the return of gold, and it's fine. Gold,
Quadrupled, almost quadrupled inflation.
yeah, stocks have quadrupled, almost quadrupled inflation and doubled the return of gold. So yeah, I mean, gold has its place for some people. Gold gets sold to people more than it gets bought by people. And so when inflation's in the news, the gold sales commercials will be about inflation and how you need gold.
Yeah.
If it's financial calamity that's in the news or war, then they'll use that to try to sell you the gold. It's a chameleon type sales process with gold.
Yeah. Yeah. I
Yeah.
mean, look at bonds even compared to gold. It's
Yeah.
it's uh it's one of those things that just it's annoying how it gets sold to people, because when you look at the actual hard data, there's no reason for it to.
Yeah. People like the shiny rock. It is amazing how it entrances people. So But we're data people, so we tend to kind of just look at that. So, all right, real estate. So, pretty cool chart from Redfin. A little hard to decipher. You have to spend some time on it, so I'll just break it down real quick. But it basically says the best time to buy a home. And the blue areas are better for buyers. Those months of the year are better for buyers. And the red areas are better for sellers. And they measured it in two ways: number of new listings and buyer leverage, which is basically how much sellers concede. So how much they say, okay, I'll come down in my price, or yes, I'll allow you to do an inspection, or okay, I won't accept cash only, I'll do a mortgage, that kind of thing. And basically the takeaway from this chart is that if you're trying to buy a house and you're trying to say, well, I have flexibility on what months I'll try to do this, what months of the year, basically December through June is when the sellers kind of win. The sellers have more power in general, December through June. And then July through November, that's when the buyers tend to win. July through November. If you want to be a buyer of a home, generally you want to be looking to do it between July and November. Kind of makes sense too, because most people who move for a distance for work or for whatever reason try to get into their home early in the summer, so the kids, if they have kids, are set for the school year to begin. Whereas if you don't buy till July or August, you probably don't settle till September, October, November, and the school year's already started, which makes it harder.
Just based on the friends I have that are in real estate, this chart makes a lot of sense. They always say that their busy season is winter and spring, just because they like working with people who are selling houses.
Right.
So that makes a whole lot of sense.
Yeah. All right.
Yeah.
All right.
I had
Where are we going?
What?
Where are we going? Take us somewhere.
We're all over the place today. Listener question.
Is that where you're going?
Yeah, yeah,
All right.
yeah, it is. I had a question, just in a meeting with one of my younger clients, asking about the U.S. debt and who owns the U.S. debt, which I think is a very good question, especially for a younger client, someone in their late 20s, early 30s. And I went to Visual Capitalist and I found this chart. Shows exactly who owns the 39 trillion of U.S. debt. So of the 31.4 trillion in public debt, 17.7 trillion of it is domestic holders. So meaning mutual and pension funds, individual, just retail investors, banking institutions, and other domestic holders.
This is a great chart.
The 9.3 trillion of the 31.4 trillion public debt is foreign holders. So the specific countries, the top three being Japan, the UK, and China, owning about 3 trillion of our public debt, and then a few other nations owning 6.5 trillion of it. And then the Federal Reserve owns 4.4 trillion of our 31.4 trillion public debt. And then the rest of it, the remaining 7.6 trillion, is Social Security, and then other government funds.
All right.
So it's intragovernmental debt. But yeah, we've got the highest national government debt in the world, and I think that's a really educated question for someone as young as they were. I won't mention names, but to ask me,
that's a good question.
To ask me that question about, hey, we've got 39 trillion in debt, but in debt to who?
Who do we owe it to?
Who do we owe a debt to? And part of the answer is ourselves, and then the other part is other people, other nations. So,
yeah.
Yeah.
Yeah, interesting. It's mostly to ourselves. It's
mostly to ourselves, but yeah.
You go buy a treasury bond, treasury bill, treasury note. That's the debt. Generally that's the debt. Yep. Yeah, and just answering the question, who owns it? What prompted them to ask that question? They just were curious.
They just kept hearing. Oh, I think this is a common occurrence for at least for younger investors, younger clients. They listen to podcasts and they hear, oh, the national debt, it's rising, it's at 39 trillion, and they hear other things that they hear a lot, but they don't understand, what does that mean?
Yeah.
In debt to who? I mean, which is a very normal question. It's, because it's never really explained. It's kind of just assumed, well, they'll know what this means. And
what it means is that politicians need to stop spending so much money. That's what it means.
I think they understand that, but I think just want to know the fine details of, wait, what? Who do we
Yeah.
Yeah.
Yeah. Yep. Interesting. Well, all I've got left is a recommendation. Do you got more?
No, that's all I had.
You have any recommendations, or you want me to just go?
No, I've been busy. I haven't been reading or watching a
All
whole bunch of
right.
stuff.
I guess I've been lazy. All right. I started rereading a book that was published in 1998 that I've read like three times. I'm about two-thirds of the way through.
Oh, you told me about this one.
It's a great book, A Walk in the Woods by Bill Bryson, and A Walk in the Woods, and Rediscovering America on the Appalachian Trail. It was a New York Times bestseller. Great book. It's funny and enlightening, and it's just basically, the author is Bill Bryson. He's not exactly a hardcore outdoorsman, and really that, but he decides he's going to hike the Appalachian Trail, which basically runs from Maine down to, I
I
believe,
think it's
Georgia.
Maine to Georgia. I'm pretty sure.
Yeah, and he's going to do it with his out of shape friend named Stephen Katz. And so these two non hiking guys are going to go hike the Appalachian Trail, which is a massive undertaking. And it's really funny. It's sarcastic. There's a lot of self deprecating humor, but you learn a lot about the history of the United States and the trail, the ecology. But it doesn't feel like a textbook. It feels like a fun, easy read. You can pick it up, and read a chapter or two, put it down, and pick right back up 2 weeks later, 2 days later. A great beach book, or if you're at the lake or something like that. But A Walk in the Woods, Bill Bryson, really, really fun book. Holds up. I mean, I get it. It's, 8 years old, or what, 9 years old, but it still holds up. It's not dated at all.
No, that makes sense that it would hold up because it's hiking the Appalachian Trail. How new does it get? But
And
I
a great writer, just a
yeah,
great writer.
I,
Fun,
I
fun
I
read.
should read that actually. That you're right. Good beach book. I tend to agree. The people you hear of hiking that trail describe it as almost like outer space, where it's just it's you feel stranded,
Yeah, yeah,
like you're lost at sea almost. But it's really cool. It just runs right through kind of the heart of our I guess eastish coast area.
yeah. Right up the
Yeah,
spine of the East Coast.
that's really cool.
Yeah.
Awesome. Well, thanks for listening, everybody. Thank you for the listener question. Please continue to send them in, and we'll catch you next time.
Bye, bye, everybody.
The Capital Clarity podcast is presented by FA's Keith Wagner, AA.MS Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.